PayPal at the moment is a business that is being looked at like Meta was last year, where the stock price plunged a lot from the highs of the pandemic and is now sitting at very low levels, while the business still has high amount of cash flows and a lot of cash on the balance sheet. With Q3 for PayPal being right ahead, maybe we should already take a look at if the stock is a buy right now, or if maybe the valuation is still not right. PayPal has many businesses. They have businesses like Venmo, they have businesses like Braintree. I don't think I need to explain PayPal itself to you, but Venmo, for those who are outside of the US, is basically sending money between your friends and family. Braintree is the payment processor. If you have an online store, Braintree allows you to process payments from credit cards, PayPal itself, anything basically. It is a very fast growing business in PayPal, so that is kind of important. They also have businesses like Honey, which is just a coupon browser extension, but that is not a big money maker. It's just a very small segment. We can see the active accounts in general are not really growing that much. PayPal's numbers are stagnating. They were growing during the pandemic, of course, and a bit afterwards, but it has not grown a lot. I do not expect a lot of growth coming here. But they don't need to grow the active accounts to achieve more revenue. They just need to grow the amount of times an account makes a transaction and how much money they spend on each transaction. We can see in general that is going well. While accounts have slightly decreased, the amount of payment transactions are up 10% and payment volume is up 11%. So they grew transactions and they grew the amount of money per transaction. The take rate is fairly stable. Now, what is the take rate? If you have like payment providers or payment services, their take rate is what their total payment volume is. What from that is their revenue. If you have a transaction with PayPal, which is worth $100, they will take around 2% in revenue, which means $2. That take rate is very important. If the take rate declines while payment volume goes up, revenue won't grow. In this case, take rate is fairly stable. It is slightly decreasing, but that is because businesses like Braintree, which have a lower take rate, are growing faster than the main PayPal services. So we don't gotta worry that PayPal is losing to competition and needs to lower fees. PayPal fees are one of the highest and they're still able to have them. That is one of the biggest worries with PayPal, that they're not going to be able to compete with all the other payment providers. But I would say Google Pay, Apple Pay, etc. have been out for years. PayPal is still growing and the take rate is fairly consistent. But one benefit that PayPal has is that it's just very trusted by users. While many merchants hate it for how many fees it takes, customers love it. They love the safety of PayPal, they love the convenience, especially their refund policy. While it is very bad for stores, it is very easy to get a refund. There are even a lot of false refunds that are given, but customers just love it because it is so easy to get a refund. Especially if you're shopping on like new stores, etc., where you want to be sure that you're not getting scammed, you use PayPal, because if you want to get a refund, it is 100% sure that you're gonna get it. That is the benefit of PayPal. People trust it, so merchants have to use it, so merchants have to pay the high fees. And we can see the mode here of PayPal is still standing. Nothing is changing, they're not lowering fees, payment volume is still growing, so everything is fine at PayPal. I like that PayPal is not overspending right now. All of them are declining in cost, so with revenue slowing down lately, they haven't done the mistake of other companies where they kept spending and spending. Very good expenses discipline here. Operating expenses only growing at 4% in total. Operating margins are fairly stable right now. One thing that worries me though is the transaction expense rate. A bit of the increase is affiliated with Braintree growing faster. If you process the payments, it's a bit more expensive for you. But still, this worries me a bit. If this continues to go up, and the transaction margin keeps getting squeezed, then I'm getting worried. But for now, this is fine in my opinion. If we see it in the next few quarters increasing, then I would be worried. Then maybe the mode is kind of eroding. They're guiding for 5 billion in free cash flow, which I think is totally doable. Especially if we look at the trailing 12-month free cash flow, 5 billion is not unmanageable. If we exclude the one-off quarter, that is very reasonable. They had a one-off quarter due to a one-off expense in Europe. Now, what are they doing with this 5 billion? They're basically planning to buy back shares and shares and shares. They have done a bunch of acquisitions and investments. They have kind of scaled it down and are now doing a lot of buybacks. They're basically gonna use all the free cash flow to buy back shares. On a 59 billion market cap, 5 billion of free cash flow doesn't sound bad. We gotta remember though, share-based compensation. They're issuing 1.2 billion in shares each year. So it's really only around 4 billion that you're getting back, which is still around a 7% buyback ratio. That is not bad. I also like that stock-based compensation hasn't exploded. They have kept it only slightly growing. So very good expense management here at PayPal once again. Revenue growth has been kind of stable until recently, and I think we're not gonna see these high numbers again. PayPal is just at a size where it can't grow that much anymore. If it gets other businesses in, and businesses like Braintree are still growing, yes, but the core PayPal platform, which is the high margin, high revenue segment, it can't grow at 18% anymore. I think realistically we're gonna see 8 to 5% here which is still not bad, but it's not a fast grower anymore. Now when it comes to valuing PayPal, they guide for 5 billion in free cash flow, which is very realistic, minus around 1 billion in share-based compensation. I'm gonna leave it 200 million away because I think they're gonna hit a bit of a higher free cash flow. There will be 4 billion in free cash flow. They have 1.1 billion shares outstanding. That is around $3.6 per share in free cash flow. And they still have a lot of net cash on hand. They have 7 billion in net cash and 17 billion in pure cash. They could increase the buybacks even, which they are gonna do. They're probably gonna go into net debt for this, which I think they can afford. They have no leverage right now, basically. So I think this is completely fine, nothing to worry about. Now when we use those $3.6 per share to value PayPal, 7% buyback ratio, plus 6% revenue growth, which is in the middle of my assumption, slightly less revenue growth after that, but still the same amount of buybacks, 10% required return, 15 multiple, we would come to a price of $60.36 per share, which is 14% of today's price. So if you believe these assumptions, PayPal is a very safe business in my opinion, very conservatively managed. Maybe that is an interesting stock for you. I already own Amex, so when it comes to payment and financial stocks, I don't want to have another exposure there. If you want to get an exposure, maybe this is a very fantastic stock, especially because the upside is fairly good. If we even believe in slightly higher revenue growth, then we're gonna come to a way higher stock price, especially if it gets a 20 multiple. Of course, there is the downside. What if they don't grow at all? Only buybacks, 10 multiple, then we are gonna have a downside of 50%. I'm not really sure what's gonna happen. PayPal has a big moat. It is very conservatively managed. It's a very great risk-reward ratio in my opinion. I'm definitely gonna look at the third quarter earnings. What do you think about PayPal? Write it down below. Have a good day.